Hey, so this is a single trading strategy using the 21 exponential moving average. It's a single strategy, but very simple. This video, or I guess the content, is meant for a group of guys that I met when I was giving away a bunch of cryptocurrency miners earlier in the 2021 year. And I promised them that I would teach them how I make money in the markets. And so I am doing that. I'm putting it on YouTube, so obviously anyone's welcome to it, and I hope it serves you well. So, guys, this is, again, just a simple strategy while I'm putting or taking the time to put something a little bit more comprehensive together for you to teach you how not only to trade, but how to analyze markets. Everything that I know from A to Z, everything that I've learned over the years of trading. Couple key things though before we get into it that I need to go over and make sure that you understand. And you're going to hear me say this a lot, but it is that important. And that is to understand that trading is a game of probability and statistics. Simple as that. There's not just one way, one absolute right way to trade. It just doesn't exist. There are many ways to trade and extract money from the market. The trick, though, is to find strategies that have a high probability of success, and you trade those signals using a rule-based approach. A rule-based approach. Basically, just having a trading plan. And not only having it, but sticking to it. It's a key piece. And when you do this and you do it consistently, you're going to be more successful than not. For instance, if you have a strategy like this one that is 60 to 70% successful, in simple terms, that means you are likely to win 6 out of every 10 times. Those are great odds in your favor. All a trader has to do is just be consistent and play the numbers game. Here's the thing though. You're going to lose. Not going to dance around that. You're going to lose. But as soon as you understand that, accept it, means the sooner that you're going to get on to winning more trades and winning them consistently. So for strategies like this one that are between 60 and 70% successful, you may even lose the first 3 out of the 10 times. But this is why consistency is key. You've got to play through. I've seen so many new traders, you know what, and I'm guilty of this too when I first started out, but not being consistent, picking up a good strategy, and you'll lose, and losing like the first couple, and they come back and say, well, the heck with this strategy sucks, it doesn't work, blah, blah, blah. When in fact, all they had to do is stick with it and be consistent. Play it through. Now, the other part of this that is needed to make your trading game work in your favor is risk management. This is very, very important. You have to protect your capital, especially during the times that your trade isn't working out. Setting your acceptable risk reward or your acceptable risk before taking the trade is part of the rules-based approach, your trading plan, and then sticking to it is really the only way that I recommend to trade. Again, it's a rule-based approach. When you stick to the rules, the outcomes are way, way better than really just cowboying your way in and out of trades. There's a saying, or I guess I should say it, they don't say fail to plan and then you plan to fail for no reason. All right, well, enough of me babbling. You know that I have a motor mouth, so let's get to it. Get that out of the way. And by the way, I've created this PowerPoint for you guys. PowerPoint. It's going to be a little bit more thorough than a YouTube video that I'm putting out because you guys know that I have no interest in being a YouTube crypto guy or trading guy. But it's available if you want it. Just hit me up on Discord or email me and I'll send it to you. First thing we want to do is set up the indicator. So we open up our trading view chart. We go to the indicator button, click, type in 4SMA, SMA, and you're going to see 4EMA, 4SMA by an author Silkheat. Choose that one. You don't have to, but it will be very helpful in the future as you are getting 8 indicators for the count of 1. And anyone that's familiar with YouTube subscriptions, you know, depending on your subscription, you are limited to the number of indicators you can have at any one time on your chart. So this gives you 8 for the count of 1. So we pick that one. I've already got it loaded. We hit our gear icon for configurations of the indicator itself. Now this is the most important part, the input. You can put it in whatever slot you want as long as it's in the EMA slot. I put it in the second because I have intentions for the first one. Key part though, 21 is our input for the moving average. Cannot mess that one up, 21. Now for the style. You can choose any color you want. It does not matter. I like to use orange because it's right there in my face. Now for the thickness. Same as the color. Choose whatever you want. Again, I just like it to be in my face. So I choose number 2. Okay that out. Got our indicator set up. That was pretty easy, right? So the base strategy. Probability of success is closer to 65, but I like to just say 60. That way there's no misconceptions. We know that's a good strategy. Now, we can increase those probabilities over 65 and actually closer to 70 by what I like to call probability increasers. But I'll cover that right before we wrap up. The strategy itself is a simple strategy, but it's very effective. It's versatile. It works on all time frames. But just like a lot of things in trading, higher time frames offer us better results, offer us more money, but they come with less opportunities, less trades. Now the shorter time frames are opposite, right? They give us more opportunities, but they come with less potential profit. Not always, but often. And there's one other caveat though. Comes with more noise on the chart, right? Lastly, this strategy's very good at scalping. Very good. I like to scalp the 2-hour myself, and even though it's not my primary strategy or trading style, I often use it to make some quick money in and out. In and out. The strategy. How do we enter this thing? So, there's a few different ways you can enter on this trade signal, but the primary rule that you have to adhere to is to wait for price to have 2 consecutive closes above or below the 21 exponential moving average. So once we have our second close, we then take the trade in the direction of the close, right? So just for example, all right, so we get our first close over, second close over, boom, off to the races. First close under, second close under, we get a retest of the 21, and that gives us about an 8% trade. What did this one come out to, by the way? First close over, second, boom. That one ended up being 40%. First candle close over, second, boom. You get the idea. Second candle close over, we enter the direction of the trade. Now, here's what I suggest. You wait for a retest of the 21 rather than just getting in at the very close of the second candle close. Rather than getting in there, we wait for a retest of the 21. Now, it doesn't happen every time, but it happens a good bit of time. It happens often. So by waiting on a retest of the 21 or getting our entry as close to the 21 as close as possible, it lessens our risk and increases our potential reward. Now, the exits, well, let me go over a couple more examples before we go to the exits. First candle close over, second candle close over, we hit the 21, we enter. God, that one gave us 32 minimum. Let's choose a lesser time frame and see if we get some results here. All right, this is probably the same trade though. First candle close over, second candle close over, we get a retest of the 21, off to the races. That's a good one. 20, we'll call it 30%. So I think that's fairly simple. There should be no misconceptions about it. Second candle close, we enter in the direction of the trade, and we try to get our entries as close to the 21 as possible by waiting on a retest of the 21 or just getting in as close as possible. Now, as far as the exits, there's no set rule for the exit like there is for the entry. It's a bit more ambiguous. Now, the 21 exponential moving average is decent as far as giving us, or helping us determine the trend. But for exits, I think that it's best probably to mix this in with our risk management because it's going to play a big part. Risk management. You guys already know about risk management. A lot of traders use like a 3-to-1, meaning their reward to risk ratio is 3 units for every 1 unit they risk, right? Or a 1-to-2, meaning they risk 1 unit to make 2 units. So we're going to set that up in the beginning, and that's also going to help with our exits. So if we set, for this one, for example, let's say we're employing a 3-to-1 risk ratio. That means we're risking that 1 unit to make 3. So here's our entry here. Let's say we risk 2% to make 6%. So our stop wouldn't have been hit, and we got our 6%. We can use that as an exit. That's what I suggest, and that's what I do is just for my exits using my reward ratio. If it's hit, I take it, or at minimum, I take a third of my position out of the market and take that profit and lock it in. There's other ways. I mean, you could use support and resistance for your exits, Fibonacci, or even supply and demand zones. Support and resistance is good. So if you see yourself coming up on resistance, cash out, take the money and run, or at minimum, take a third off, if not a little bit more. I guess to wrap up risk management, so we set that up in the beginning because that's part of our rule-based approach. And we'll just, for conversation's sake, we'll use 3-to-1. We decided that on the beginning of the trade. Now, as a general rule, if you're not wanting to risk a lot of capital, that equates to about 1% of your total equity. A medium risk trade is 2 to 5% of your total equity, and 5 or more percent is considered high risk. Not that the trade is high risk, that you're just employing higher risk of your capital for the trade itself. Now, setting our stops, though, just like we we did for instance, we did a 3-to-1. So our stop here would have been 1% or 2, whatever. We got that one. Let's find another example though. First candle close under, second candle retest of the 21. If we did a 2-to-6, stop would have never been hit. We got 15%. I think you get it. There should be no reason to go back over this. Again, the main thing is your second candle close over for the entry. Now, I talked earlier about how you can increase the probability of success, and here are a few options that you can do that. And this is gonna help you get, I guess, better odds of getting a paycheck from the market that you're trading. So, 1, only trade this strategy in a trending market. Cut out those signals that are in consolidation times, right? Or in chop. This, for instance. I mean, this higher time frame gave us a little bit, but really it was pretty tight, right? So if we save it for trending markets, that's going to increase our probability of success. Another option is having confluence, using another indicator to back up your trade idea. For example, the RSI to determine your momentum. Number 3, taking those entries at areas of value, like retest of the 21, or ones that coincide with good support or resistance, or even other moving averages. Option number 4, analyzing the slope of the 21. If that sucker is shooting straight up, then it's probably safe to stay in the trade a little bit longer and ride the trend out. Option number 5, candlestick strength. Now, if those candlesticks are showing weakness, then and if you're in profit, take the money and run. If it's showing strength, on the other hand, then let that trade run. That's going to capture you more profit. Lastly, last option, finding a time frame that is respecting the 21 big time. That is very strictly respecting it. And this is one reason I like the 2-hour. It respects it. 12-hour does as well, or has been at least. 4-hour has been. So that wraps up the ways to increase your probabilities of success. All right, to conclude, you got to remember, you cannot forget this. Trading is a game of probability and statistics. Keys to being successful is being consistent. Stick to your rules. Protect your capital with risk management. Don't be too greedy. Take the money when the market gives it to you and pay yourself. Start off small. You can even use a test net. At minimum, start off small. And after you gain some confidence and you're consistently winning, then just up your position size. It's just a numbers game then. If you can make money trading with small money and make it consistently, then all you got to do is up it, and you can make money with bigger money consistently. So I wish you guys the best of luck. This is just one of a series of videos I'm going to put out for you guys while I'm working on the, I guess, more comprehensive how to analyze or do technical analysis from A to Z. So just bear with me. But the strategy is great. You know, a lot of people have made a great amount of money off of it, and it's still one of my favorites today. So I wish everybody the best of luck, and happy trading.